The next major artificial intelligence contest in healthcare is not clinical, it is administrative. By the mid-2020s, the United States healthcare system had scaled into a $5.3 trillion economy. That constitutes roughly 18% of the national gross domestic product. So today's analysis pulls from a stack of macroeconomic research and health tech market data to answer one mission-critical question. Who actually captures the economics when AI takes over healthcare billing?
Well, to answer that, you have to look at the underlying architecture first. Healthcare essentially operates on two distinct machines. The first machine delivers the physical care. The second machine converts that physical care into institutional money. And artificial intelligence is moving into that second machine at an unprecedented velocity.
Right, we are seeing a complete symmetry of automation. On one side, hospitals are deploying predictive AI to automate documentation, clinical coding, coverage checks, prior authorizations, and complex claim preparation.
And on the exact opposite side of that ledger, health insurance plans are deploying equivalent software. They are automating the reading of those benefits, enforcing clinical criteria, scanning contract rules, and executing payment policy.
Which means the identical episode of patient care is transformed into a machine-readable argument from the provider. And that faces a machine-readable judgment from the payer.
Yes, the same care episode faces a purely algorithmic evaluation.
Before we trace the financial consequences of that algorithmic tension, let me state this clearly. If you value analysis that follows healthcare beyond the technology, into the contracts, capital flows, and companies that capture the economics, subscribe to the Unlayered Global. Let us examine the hospital's operational reality first.
Well, look at the working capital problem. Delivering medical care does not automatically generate cash. It generates a requirement for data. The encounter must be precisely documented. The exact service must be coded. Payer-specific coverage conditions must be satisfied. Exceptions require additional documentation, and initial denials must be formally appealed.
That structural gap between delivering the service and collecting the payment is a massive friction point. Consider the balance sheet. A hospital pays its surgical nurses on Friday. Its pharmaceutical suppliers demand payment at 30 days. But the reimbursement for that specific surgery might be caught in administrative adjudication for 90 days.
Exactly. And artificial intelligence tools are designed to reduce that specific financial friction. The initial data supports those productivity gains. Ambient documentation software reduces clerical hours. Automated coding systems identify incomplete charts before they age. Revenue cycle algorithms catch claims that are statistically likely to fail before they are even submitted.
They prioritize which denials are mathematically worth the labor cost of an appeal.
But, that assumes a static environment. As an analyst evaluating these markets, you must account for the administrative rebound effect.
The second-order effect of this efficiency.
Right. If automation makes a claim significantly cheaper for a hospital to prepare, the hospital can afford to submit far more rigorous, intensive claims. And if automated review becomes cheaper for the insurance payer, the payer can afford to review a much higher percentage of those claims.
So if AI makes the appeals process cheaper, more denials become economical for the hospital to contest. The cost of executing each individual administrative action falls to near zero. But the absolute number of administrative actions in the system rises.
It rises exponentially. AI may reduce the cost of healthcare bureaucracy without reducing the actual volume of bureaucracy.
And the baseline volume is already staggering. A federal review of Medicare Advantage prior authorization requests examined a sample of denials. It found that 13% of the denied requests actually met Medicare coverage rules.
That 13% figure is critical. It does not suggest that the majority of requests were improperly denied. Rather, it exposes a structural vulnerability that becomes highly material when you introduce automation. A minority error rate, when applied to millions of automated decisions, translates to massive sums of misallocated capital.
It also translates to a massive labor pool. Physician surveys calculate the current prior authorization burden at roughly 40 requests per physician per week. That consumes approximately 13 hours of dedicated physician and staff time. That is the exact labor pool AI vendors are targeting.
But removing the human touches does not answer the underlying question for the system. Does healthcare actually need fewer transactions? Or is the software merely processing the exact same financial conflict at a faster clock speed?
To understand that, you have to view the conflict from the payer's rationale. Intensive review is not inherently irrational. The entire insurance business model depends on accurately distinguishing covered services from uncovered services.
Right. They must separate supported medical requests from unsupported ones and correct billing from potential waste or abuse. If the payer does not enforce those controls, the financial risk is ultimately absorbed by the broader premium pool.
The market distortion begins when the marginal cost of that review drops. If we model a scenario where examining one additional claim costs the payer the fraction of a cent, the payer's software can afford to screen every single data field.
It can reference years of patient history and apply highly complex actuarial rules much earlier in the adjudication process.
Now reverse the camera back to the hospital. The provider deploys counter software. It reads the payer's automated denial, instantly locates the required clinical evidence in the electronic health record, maps that evidence directly back to the specific payer contract, and fires off a rapid response.
This is machine-to-machine reimbursement negotiation. We are not talking about autonomous avatars arguing in a virtual chat window. We are talking about something far more mundane, yet fundamentally more consequential for the economy. Software on both sides continuously optimizing the probability of payment.
Which leads to a crucial realization for anyone allocating capital in this sector. The real unit of analysis here is not the AI model, it is the contract itself.
Yes. The financial incentives matter far more than the raw intelligence of the algorithm. A superior neural network does not fix a structurally flawed contract.
If a provider's contract rewards them for documenting higher medical intensity, their software captures every justifiable unit of intensity. If a payer bears the financial risk for higher utilization, their software systematically restricts that utilization. Both organizations are behaving entirely rationally, yet the combined system remains incredibly expensive.
We must trace where those savings actually flow. If a health insurer successfully reduces its internal administrative expense through automation, that capital does not automatically convert to pure shareholder profit. You have to factor in medical loss ratio rules.
Just to ground that metric for a moment, the medical loss ratio, or MLR, generally requires insurers in major U.S. markets to spend 80 to 85% of their premium revenue strictly on medical care and quality improvement. Only the remaining 15 to 20% can cover administration and profit.
Precisely. So regulatory constraints, alongside employer bargaining power and future premium pricing, heavily dictate who actually retains the operational gain. Furthermore, consider the employer-sponsored coverage market. Another major balance sheet sits directly behind the insurance company's logo.
Because many large corporations self-fund their employee health benefits. The employer retains the actual claims risk. The insurance company merely acts as an administrator, operating the network and processing the transactions for a fee.
So if you are managing corporate liabilities for a self-funded employer, your analytical question must be highly specific. Does this AI adoption actually lower your total medical and administrative bill, or does it merely change the structure of the fee you pay to the intermediary?
Meanwhile, the hospitals are operating under their own rigid constraints. Reimbursement rates for public programs like Medicare are administratively determined. Commercial rates are fiercely negotiated. So a hospital cannot assume that a dollar saved in clerical efficiency remains in its operating margin.
That specific friction is what elevates the middle layer of the healthcare ecosystem. Consider the infrastructure providers.
The critical middle layers. You have the electronic health record platforms, the claims, clearinghouses, payment integrity software, and cloud platforms.
Think about the market position of those entities. A clearinghouse sitting between the hospital and the payer does not care whether the payer or the provider wins a specific billing dispute. They simply need their proprietary software to remain the essential highway on which both sides are legally forced to transact.
Which requires investors to update their fundamental frameworks.
It does. I mean, look at the structural comparison. In the pharmaceutical sector, a drug company builds a defensive moat through legal patent exclusivity around a single molecule. Administrative AI builds its moat through entirely different mechanics.
It builds it through proprietary data integrations, through massive libraries of historical payer rules, and through deeply embedded enterprise contracts.
Once a hospital system integrates an AI revenue cycle tool into its core accounting infrastructure, ripping that software out means risking a disruption in daily cash flow. Few chief financial officers will authorize that risk. Therefore, the embedded workflow remains highly expensive to replace, even if the underlying algorithm eventually becomes a cheap commodity.
You are looking at a toll booth model. It functions more like a financial exchange or a payment network than a traditional software product.
That is the mandate for investors. Separate AI adoption from AI profit capture. A hospital can heavily automate its back office and still suffer from razor-thin operating margins. An insurer can automate its review process and still face severe medical cost inflation.
But the company sitting on the mission-critical transaction rail collects recurring revenue as the broader ecosystem fights.
Watch the toll booth, not just the model.
We must also evaluate the concept of minimum efficient scale. Deploying these enterprise AI systems is not a simple software subscription. It requires heavy capital expenditure in data engineering, continuous cybersecurity monitoring, legal compliance, and AI governance.
Large consolidated health systems have a structural advantage there. They can amortize those massive fixed costs across billions of dollars in revenue and millions of patient encounters. Smaller, rural, and independent hospitals lack that denominator. They simply cannot absorb the upfront capital requirements.
The technology does not explicitly mandate corporate consolidation, but it unequivocally raises the minimum efficient scale required to survive as an independent healthcare organization.
Which makes vertical integration highly attractive from a strategic standpoint. Look at the modern healthcare enterprise. A single holding company might now own the insurance plan, the physician groups, the pharmacy benefit manager, the data infrastructure, and the post-acute care management.
By integrating vertically, they internalize the friction. A billing dispute that would normally consume administrative capital between two independent companies simply becomes an internal accounting transfer.
But that strategy forces a very complex regulatory trade-off. Antitrust regulators face a rigid, awkward choice. If they enforce market fragmentation to preserve competition, they actively multiply the transaction costs, because every independent player must constantly verify and argue with every other player.
But if they permit integration, they remove the friction at the direct cost of centralizing market power.
And artificial intelligence sharpens that exact antitrust tension through the data feedback loop. Corporate scale produces massive data sets. That data improves algorithmic operational efficiency. Better operations attract more patient volume, and that new volume generates even more data.
It is a closed-loop system. That dynamic turns administrative efficiency directly into compounded market power. Once the switching costs reach prohibitive levels, the ultimate winner in healthcare AI may be locked in long before the technically superior model ever reaches the commercial market.
We also need to bridge the gap between digital systems and the physical economy.
Right, the supply chain for healthcare data is entirely digital, but the consequences manifest in physical capacity.
Take a routine operational scenario. A patient is medically cleared to be discharged from a highly expensive acute care hospital bed and transferred to a specialized rehabilitation facility.
If the required coverage approval for that transfer is delayed by algorithmic latency, perhaps the payer software flags a discrepancy and pauses the authorization. That patient remains physically stuck in the acute care bed.
And that bed is now unavailable for a new emergency patient. The digital claim queue literally becomes the physical bed queue. The software is not floating abstractly above the real economy.
It is physically tethered to discharge planning, nursing ratios, and the working cash required to procure medical supplies. The dependency becomes glaringly obvious during a cybersecurity failure.
Exactly. When a major claims clearinghouse or payment intermediary goes offline, providers instantly lose access to the financial plumbing. Claims halt. Payments freeze. The entire system is forced back into manual, paper-based workarounds.
The Change Healthcare cyber attack provided a stark, real-world demonstration of this systemic vulnerability. It proved that disruption at a single, heavily integrated intermediary can instantly propagate financial distress through the broader U.S. payment system.
A highly automated network may technically be cheaper to operate during normal conditions, but it becomes exponentially more expensive to secure against catastrophic failure. That cost of resilience is a major bottleneck.
The industry cannot simply delete administrative budgets. They must redirect that capital to finance redundant data connections, advanced identity security, immutable audit logs, backup workflows, and intensive disaster recovery protocols.
The savings generated by automation are inevitably recycled into protecting the automation itself. And there's also the acute bottleneck of human exception management. As routine claims become frictionless and automatic, the highly ambiguous, complex cases accumulate.
They pile up on the desks of a severely limited number of human experts who are actually authorized to override, explain, or legally defend a decision.
Automation makes accountable expert judgment more scarce, not less. You are merely moving the operational queue from frontline clerical labor to highly specialized, expensive human review, and that accountability carries a hard financial premium.
When an automated recommendation results in an incorrect payment or worse, inappropriately denies access to critical care, the liability must be assigned. Who owns the financial and legal error? Is it the hospital for failing to override the machine, the payer for implementing the policy, or the vendor who wrote the algorithm?
Indemnities, audit rights, and specialized cyber liability insurance become permanent fixtures of the cost structure. The popular premise that AI lowers administrative cost is analytically incomplete. It removes frontline wages, but adds integration, governance, compute, cybersecurity, liability, and compliance overhead.
The only mathematically useful metric is the net cost after every one of those factors is fully priced in. Macroeconomic demographics are simultaneously pushing from the opposite direction. An aging global population means the baseline demand for healthcare is aggressively expanding.
We are looking at vastly more chronic disease management, complex prescriptions, and daily interactions with insurance programs. Healthcare and social assistance was already projected to be the fastest-growing major U.S. industry sector moving through the mid-2020s.
Therefore, these algorithms are not automating a static, predictable workload. They are desperately attempting to prevent administrative labor costs from rising faster than the baseline demand for clinical care, which generates a severe productivity paradox.
Yes, in macroeconomics, it is entirely possible for operational productivity to improve while total systemic spending continues to rise. Let us apply the math. A hospital deploys AI and drops the administrative cost of processing a single transaction by 80%. The unit cost looks excellent.
But if the algorithmic rebound effect causes the total volume of transactions to grow by 300%, the total capital spent on administration still goes up.
The downward direction of unit cost does not dictate the trajectory of total systemic cost.
And as investors look to scale these solutions globally, they hit geoeconomic borders. Healthcare AI will not cross sovereign borders as fluidly as consumer software or social media algorithms.
Because reimbursement models, medical privacy laws, clinical coding standards, and strict data governance rules differ fundamentally from one jurisdiction to another.
Europe, for example, is currently constructing a rigid regulatory framework designed to support health data exchange, but it tightly governs secondary use for research and commercial innovation. Other sovereign systems demand nationalized infrastructure or strict data localization, meaning the servers physically cannot leave the country.
The true geoeconomic prize is not just accumulating raw data. A massive database of inaccessible, siloed, non-compliant medical records does not constitute a durable business asset. The actual defensive moat is permission data that is legally integrated into a working clinical and financial system.
Future healthcare AI clusters will therefore only form where four specific assets coexist: clinical scale, legal permission,
Computing capacity.
and institutional trust. When we synthesize these dynamics to evaluate the decades ahead, three distinct structural paths emerge for the healthcare ecosystem.
Path 1 is genuine compression. The system actually simplifies. Coverage rules become fully computable at the exact point of care. Routine authorizations happen instantly. Claims arrive at the payer flawlessly clean. Human capital is strictly reserved for managing complex clinical exceptions.
Under this path, the metric of success is how few administrative steps are required to move from appropriate medical care to correct financial payment.
Path 2 is algorithmic escalation. This is the arms race scenario. Providers optimize clinical documentation to maximize revenue. Payers optimize denial software to minimize payouts. Providers automate their appeals. Payers automate the counter reviews. Every single transaction becomes incredibly cheap to execute, yet the total system chokes on vastly more documentation, disputes, and compliance overhead.
In that escalation model, the intermediaries do not disappear. They thrive. They evolve into highly specialized, highly profitable software companies feeding off the friction.
Path 3 fundamentally changes the underlying incentive. As alternative payment arrangements expand, the payer and the provider are forced to share direct financial responsibility for the total cost of care and the clinical outcome.
When both organizations benefit financially from eliminating avoidable medical spending rather than fighting over opposing sides of a fee-for-service claim, the administrative arms race loses its economic purpose.
Under this path, AI pivots from being a reimbursement weapon into shared coordination infrastructure. Incentive alignment, not raw computational power, remains the deepest long-run variable in this market.
To evaluate this space accurately over the next decade, you must apply a rigorous, six-part analytical framework.
Ask these exact questions. Did the administrative cost per episode fall? Did the absolute total number of administrative transactions decline? Did legitimate care reach approval faster? Did the provider's cash conversion cycle materially improve? Did the ultimate consumers, the patients and employers, see lower total costs? And crucially, who captured the financial saving?
Before we conclude, consider the logical endpoint of this escalation. If these models become flawlessly efficient at generating and denying claims based on millions of variables, do we eventually reach a state of complexity where humans are legally or practically barred from overriding the machines at all? Consider your position as a patient or an investor if accountability becomes fully opaque.
If only the speed of the transaction improves, the system has failed the fundamental test. The durable winners will control trusted data and transaction infrastructure. The vulnerable players will be those forced to buy capabilities without the scale to recover costs.
If patients still wait and households still absorb costs, AI has merely industrialized bureaucracy. Subscribe to the Unlayered Global, where we trace healthcare from technology to reimbursement to the balance sheet. Because if the economic rules do not improve, artificial intelligence may not eliminate healthcare bureaucracy. It may industrialize it.